banks have mastered the art of deceiving us, and one of their biggest fibs is the idea that our money magically multiplies within the cozy confines of our bank accounts. But here's the truth they conveniently forget to mention. While your account balance might soar with interest, the sad reality is that your hard-earned cash isn't growing in value or keeping pace with inflation. In fact, it's like watching money slowly evaporate into thin air while your bank account plays host to an inflation party. So next time you're tempted to stash your savings in the bank, think twice. In this video, we will share 6 resources that can prevent the decline of wealth and assist you in building wealth across generations. 1. One of the assets that can help safeguard against wealth erosion and promote intergenerational wealth is precious metals such as gold, silver, and platinum, often referred to as God's money. Discover the hidden truth about money's value. While we rely on it to store our future wealth, governments continue to crank up the printing presses to cover their deficits. Suddenly, that innocent piece of paper we call the dollar could crumble into worthlessness before our eyes. That's where the experts step in. They unveil a clever strategy: invest in rare and precious assets. By embracing something truly valuable and hard to replicate, you shield yourself from the uncertainty. It's time to heed their advice and secure your future with scarcity. The primary factor driving the wealthy to allocate a portion of their portfolio to precious metals is the significant reason behind it all. Assets like gold, silver, and platinum have consistently demonstrated their ability to increase in value, particularly during periods of rampant inflation. Consider this. Back before the 1950s, 1 ounce of gold could be acquired for a mere $400. Fast forward to 2023, and that same ounce is now valued above $2,000. Astonishing, isn't it? And here's the intriguing part. According to PrimeXBT's gold forecasts, this upward trend is projected to continue, potentially reaching an astounding $10,000 per ounce by 2032. It's no wonder the affluent choose to safeguard their wealth with these timeless treasures. In approximately a decade, your gold investments could potentially increase 5-fold, offering a stark contrast to the diminishing value of cash. Similarly, other precious metals prove to be superior to holding cash in a bank. If you seek to incorporate gold exposure into your portfolio without acquiring physical gold, investing in gold exchange-traded funds or ETFs provides a viable solution. Gold exchange-traded funds are remarkably cost-effective investment instruments that provide you with returns depending on the fluctuations in the price of gold, eliminating the need for you to personally possess or manage physical gold. 2. Raw materials, industrial commodities. Precious metals like silver, cobalt, nickel, and copper are not only scarce but also possess natural properties that make them indispensable industrial commodities. They are used in various industries for applications such as electronics, medical equipment, nuclear reactors, and more. Their unique characteristics cannot be easily replicated by alternative materials, leading to high industrial demand. The demand for cobalt has experienced a significant surge since 2020, primarily due to its vital role in manufacturing batteries for electric vehicles. As a result, its prices have skyrocketed, rising from $20,000 per ton in 2012 to $40,000 per ton in 2022. This represents a remarkable 100% increase within a span of just 10 years. Consequently, possessing exposure to these raw materials can considerably enhance your investment portfolio during periods of high demand. Nonetheless, not everyone possesses the financial capacity to invest substantial amounts in procuring raw materials, and the challenges of physical storage and finding suitable buyers also pose obstacles. Therefore, opting to invest in mining company stocks like Rio Tinto, mining-focused mutual funds, or derivatives such as futures and options are all excellent methods of attaining such exposure. 3. Safe haven currencies. The stability of geopolitical situations is crucial when making investment decisions in the fiat currency period of today, where no currency is backed by gold. This is the reason why wealthy people continuously opt to save their money in Swiss banks. Switzerland, which is renowned for having a strong economic system, offers a geopolitical setting that is far more stable. As a result, during times of unrest and instability, the Swiss franc is frequently regarded as a safe haven asset. Numerous examples have shown the phenomena. For instance, considerable amounts of money were transferred to Switzerland during the global financial crisis of 2008 and the Eurozone debt crisis of 2009 as a precaution against currency devaluation and to protect wealth. Furthermore, in international trade, the Swiss franc is a useful alternative to the US dollar. When the US slapped restrictions on Russian energy trade during the most recent Russia-Ukraine crisis, it served as an illustration of this. In retaliation, Russia carried out transactions in Swiss francs. Such occurrences have increased demand for the Swiss franc, which has led to considerable increase in value relative to other currencies. Early in 2023, the Swiss franc-US dollar exchange rate was 1.1074. This allowed owners of Swiss francs to almost immediately see a sizable boost in wealth. When it comes to being a trustworthy store of value, currencies like the Swiss franc, British pound, and Chinese yuan are seen as being superior. Not everybody, meanwhile, has access to Swiss bank accounts. Forex brokers like Forex.com and currency exchange traded funds provide possibilities for smaller investors to obtain exposure to several currencies with low-cost investments starting at only $100. These platforms give users the chance to participate in the currency market and maybe profit from exchange rate changes. Number 4. Sovereign Guarantee. Have you ever examined the US dollar in detail? Inscribed on it is the phrase, "The note is legal tender for all debts, public and private." Have you ever thought about its importance? According to US law, the US dollar has been acknowledged as the official legal tender since 1971 when President Nixon ended the gold standard. Because of its worth as a medium of exchange as a result of this categorization, we consider it to be a suitable method of payment for any good or service. Fiat currencies have no tangible backing, but their value relies on the trust in the supporting government. Investing in sovereign guarantees, such as government bonds, is considered a reliable way to preserve value. Governments strive to avoid default as it would have severe consequences for the entire nation. Therefore, investing in sovereign guarantees is seen as a secure choice due to the government's commitment to honoring financial obligations and preventing national collapse. Government securities, or GSECs, are thus one of the safest ways to invest in national guarantees. Focusing on stable governments with investment-grade credit ratings is crucial though. A good example is the 2009 Greek national debt crisis, which required successive bailouts from the IMF, Eurogroup, and ECB to handle its debt. In order to reduce risks related to sovereign debt, it is necessary to evaluate a government's worldwide strength while investing in GSECs. To have exposure to governmental guarantees, investors in the US might choose to invest in treasury bills, notes, and bonds. Compared to maintaining money in a bank account, these investments frequently offer higher returns. Additionally, they have the support of the US government's power in the world economy. Through the Treasury Direct portal or the secondary market, small investors have the option of buying treasury securities directly from the government. Individuals can now take part in these investments and gain access to the stability and dependability that come with governmental guarantees. 5. Value stocks and mutual funds. Treasuries are undoubtedly a superior investment than keeping cash on hand in terms of returns. Treasury investments often yield lesser returns compared to stocks due to their low-risk character. For risk-averse investors, minimal risk is a crucial factor, but the majority of investors prefer bigger returns. Stocks give investors a way to get those better returns. It's important to remember that not all stocks are equally risky. Value stocks and growth stocks are the two broad categories into which the stock market can be divided. Investors have a variety of options with varied risk and growth possibilities available to them through this division. Growth companies, especially in the technology sector, are more prone to risk due to their involvement in cutting-edge concepts and technologies that could fail more frequently. Value stocks, on the other hand, are viewed as less hazardous due to established and steady demand in the near future, like Nucor, which operates in the industrial metals sector. Value companies with solid fundamentals offer consistent and stable price growth as well as dependable dividend payments. However, it might take a lot of time and effort for regular investors to thoroughly analyze the fundamentals of any specific value stock. 6. Land and real estate. Land is regarded by accountants as a non-depreciating asset because of its rarity and enduring demand. One of the most significant resources throughout history, land is being used today for vital activities like housing, education, business, industry, and agriculture. The need for land doesn't change despite the expanding world population. Demand is constant for residential dwellings, offices, and commercial buildings built on land. Therefore, in a portfolio of investments, both real estate and land are great inflation hedges. In spite of a large decrease during the 2008 housing bubble, a Bloomberg investigation shows that property prices tripled from 1992 to the 2020s. Exposure to real estate is therefore advantageous when the value of the dollar declines. The majority of small investors, however, tend to think about real estate investments later in life and tend to concentrate primarily on their own residential property. Although having a fully paid-up home is a common net worth goal for people in their 40s, it is advisable to think about investing in the retail real estate market at any age. Contrary to common belief, getting visibility for real estate doesn't cost a lot of money. Purchasing REITs, which are similar to real estate mutual funds, is one possibility. Ventas Incorporated, or VTR, which specializes in healthcare real estate like senior housing, research centers, and hospitals, is a well-known example in the US. As an alternative, you can take out loans to purchase rental properties with the rental income paying costs, making mortgage payments, and making money. Number 7. Collectibles. The same asset class includes vintage cars, priceless works of art, artisanal luxury handbags, limited edition watches, and even first printings of classic books. The value of a historic car increases over time, whereas the value of a regular car decreases dramatically once it is driven on the road. Vintage cars appreciate in value over time, much like fine wine. For instance, a 1955 Mercedes-Benz 300 SLR Uhlenhaut Coupe reportedly sold for an astounding 135 billion euros in 2022 per Autocar. Since there were only 2 of these cars made, they are highly prized rarities among auto aficionados. In the same way, a Saudi prince purchased Leonardo da Vinci's famous painting Salvator Mundi for an amazing $450 million at a Christie's auction in 2017. The fact that these extraordinary products act as enduring stores of value is what drives wealthy people to invest such substantial sums in limited edition goods. These unusual items have the potential to fetch unfathomably high amounts if one can locate the appropriate buyer. Investing in collectibles may seem like a pipe dream to the ordinary investor. To sell rare baseball cards, comic books, action figures, and other collector objects, however, internet markets like Whatnot offer fantastic options. Additionally, websites like Convey and Masterworks provide the possibility to buy a portion of a collection if full ownership is not financially viable. Without needing to make an outright purchase, these platforms enable investors to take part in the potential value growth of collectibles. Thanks for joining Stash Cash. Subscribe and hit the bell to stay updated. Share with others to empower their finances too. Find balance, make informed decisions, and live purposefully. See you next time as we unlock financial prosperity. This is Stash Cash signing off.